Hey everybody, Marty Mazzori here, Thursday the 19th of September 2024 with your weekly video update. My schedule the next couple of days demands that I do it today, plus I get to because there are no data points coming out tomorrow that are included in our general conditions index. So I was able to score the index today. Want to talk to you about that. We had quite a nice move in the right direction and share some of the components of our index with you, and then definitely want to spend some time on these markets. Quite the day today in equities. So in front of you is the graph of our index. We call it the PWA index. So as I've been pointing out all the way back here, first of all, in August of 2019, this back here had us beginning to get defensive. Bought gold in December, hedged with put options. So we had a good experience in terms of where we were able to not take the brunt of the massive decline around the whole COVID lockdowns. We had a very brief recession in there. We thought it would be much harsher, but as we've discussed, 10 or 11 trillion of combined fiscal and monetary stimulus kept what, again, probably would have been a deeper recession from happening. Obviously, all that liquidity going into just about anything that has a price, pushed equities, real estate, cryptocurrencies, you name it. And sadly, groceries and things people buy to keep living very, very high in price. Then conditions rolled back over and our recession light, as I like to say, has been lit well over a year now. And again, this is not a timing tool, it's just a risk tool. It tells us what the risk in terms of fundamental factors in the economy and what that means about the risk reward for various asset classes. Almost came back into positive territory early this year and have rolled over since. Now, we had a large 9-point move here week over week, and that's a significant move. Still negative to the tune of 23 points. In terms of the inputs that I wanted to just share with you, I'll do this part quick because, again, I do want to get to the markets. Retail sales came out this last week. I talked about that on the written blog a day or so ago. 2.1% year over year. Adjust for inflation and something like 17 in the last 22 months, I think 7 of the last 8. We actually had negative real retail sales. So it's one thing to say that retail sales are up, but when you factor in that these are nominally based and that the entire gain was more price increase than volume, isn't quite as rosy a picture as some might have us believe. Core retail sales went up by 0.29% month on month. And then the Redbook retail sales, which are higher frequency, they come out weekly, 4.6% on an annualized basis. But again, they give us this week to week. And you can see that it, from a growth standpoint, pretty much has flattened out since, last quarter of last year or so. So we'll see how this plays out. But, retail sales, depending on where and who's doing the buying, nothing that really inspires a tremendous amount of confidence, but certainly not recessionary at this juncture. Housing starts, single family in particular. This went from negative to neutral for us. You can see the big jump that we had there. From a go-forward standpoint, maybe more importantly, housing permits, you can see that they also rose a little bit. That went from negative to neutral for us. The housing index, which measures home builder sentiment, as you can see, is still very negative. Below 50 says that the housing market is contracting. And you can see that prospective buyers traffic is not good either, historically speaking. That's way below 50. One thing that's improved is the forward outlook. You can see that rose above 50. That's the purple line. So current conditions is orange. The forward outlook is purple. And of course, that reflects the prospects for lower mortgage rates. We're going to look at something, though, that's quite counterintuitive in terms of what rates have done since yesterday when the Fed cut the Fed funds rate by 0.5%. U.S. leading economic indicators came out. And what we do with that is we created a ratio of the leading to coincident indicators, right? So the purple line is coincident. That just says, are things getting better or worse for the indicators that tell us what's happening on the ground right now. The green line are leading indicators. These are ones that give us an indication of what's going to happen going forward. And then the ratio, is the comparison of the two. Actually, Bespoke Investment Group was where I saw this, and we just kind of copied what they do. And this has been a good indicator. You can see the red areas are recession. So when we start rolling over, you need to start thinking about recession risk. So right now we're at a level still that we've never been without being in recession with this particular indicator. However, as you can see, and it's because the leading indicators are getting less bad. They're still negative, by the way, which is still not a good thing, but the degree of the negativity has gotten a little better. So again, clearly not out of the woods, but moving in the right direction. This one I threw up there, spent a lot of time on this. This was my illustration for Wile E. Coyote. Here is S&P earnings, right, in the aggregate, running over the cliff while the cliff is there, and the idea is that ultimately they come down, and that would be a recession, which this still flashes that risk in our view. And you can see why we did that. You can see that typically this ratio rolls over hard before the earnings reality sets in. Still hasn't happened though, and maybe, as I think Wall Street is certainly betting on right now, maybe we don't get it this time. Maybe the recession gets pushed off. I do think recessions are still ultimate. I do still think that despite the best efforts of the powers that be, that the economy is still cyclical. And of course, our concern is the more they succeed in pushing it out with stimulus, sadly, the harder we may ultimately have to suffer for it. But of course, all that remains to be seen. The economic surprise index for the U.S., that went from negative to neutral, not quite in the positive territory, but the move is, impressive enough for me to take this from negative to neutral. So is the data coming out relative to what economists had predicted. Still negative, still a little worse, but not nearly as bad as it had been. When we're below zero, it doesn't mean we're in recession, by the way. It just means that the data has been worse than what economists had anticipated, and that's looking a little better. Still worse, but looking a little better going forward. Wanted to show commodities, and again, we're going to talk about inflation prospects. Last week, I told you that this was a bullish-looking chart, and commodities continue to rise. This is the Bloomberg Commodity Index. That says something potentially positive about the state of the economy. Copper, some call it Dr. Copper. They say it has a PhD in economics because it's the ubiquitous, construction material. You can see that that's been rebounding. Very sensitive to activity in China. China's been a real mess. Maybe this is traders trading up, the prospects for something happening there, or for just a better economy going forward. And then the staples to discretionary ratio. Remember, I've been saying that this has been flashing high recessionary risk when staple stocks, the things people need to buy because they want to live, versus discretionary stocks. Of course, stocks are the companies that produce the goods that we buy when we have discretionary income. Still, a 4% spread is substantial, staples over discretionary. But what a drop from, the 14% just a month ago, right? So that says that people have been rotating perhaps out of staples into discretionary, or just buying discretionary at a lot more aggressive clip, so to speak, than they were buying staple stocks. Okay, so with that in mind, before I get to markets and to interest rates, just to kind of tell you today's action, which I thought was very interesting. As you probably know, the market had quite the day today. The stock market did. The S&P 500 rose by a whopping 1.7%. The Dow Jones Industrial Average rose by 1.25%, good for 520 points. The NASDAQ 100 index screamed higher by 2.5%. We'll look at that chart here in a second. The equal weight index, which speaks more to breadth, wasn't up quite as high, but still just a shade above 1%. Plenty impressive enough. So just looking at our core positions, Our best performer was uranium miners, up 3.75%. Second best was industrial metals miners, up 3.43%. The next one was silver, up 3.12%. The next was tech stocks, up 2.97%. Then palladium, a recent ad of ours that's done real well, up 2.75%. Then we get to European stocks and so forth. Now, the things that did not do at all well today were utility stocks, were down 0.59%. Long-term treasury bonds were actually down at least 0.33%, depending on the tenor you're looking at. REITs, the real estate investment trusts, were down 0.25%. Consumer staple stocks were down 0.57%. So what am I referencing? Things that you buy when you're worried about the state of the economy, yes, they're down. But also things that tend to be very interest rate sensitive, like utilities and long-term treasury bonds. So what is that about, right? They just cut 0.5%. And I'm telling you that interest rates actually went up. And remember, mortgage debt is not tied to the Fed funds rate. They're indexed to things like 10-year treasury bonds. I know everybody's wanting that 0.5% cut, but it all depends on how the market interprets it, right? And let me just jump to that chart. Here's the 10-year yield. Now, it did come off of today's highs, but it was still higher on the day. But remember, we got the rate cut yesterday, and rates popped big time, and they actually rose even the day before, as Fed funds futures were pricing in better chance of a 0.5% rate cut, right? So why would interest rates go up, right? Why would interest rates on longer term debt and on longer term bonds go up? Well, you could argue that they were way oversold, and technically they were looking like they should be a buy, right? So it's a sell the rumor, buy the news event, and we got a buy signal here on the MACD. But you could also argue that with the market at all-time highs, with the economy, and I'm going to use air quotes, strong. I watched Jay Powell's press conference. It was amazing how bullish he sounded about the state of the economy while they do a double rate cut. Reminds me a lot of 2019. Clients, if you recall way back then in the videos and in our meetings, I said, the Fed is saying that everything is okay, but we think they're going to start cutting interest rates because our view is that recession risk is now dangerously high. And sure enough, they started slashing interest rates from like August, September 2019 on, when they were publicly telling everybody the economy is in great shape. Now, you could argue today that, inflation has come down, the neutral rate of interest is lower, therefore we can go down to that. I think you got to be careful with that. Jay Powell seems to be dovish in his DNA. A 50 basis point rate cut, we actually think is consistent with what we're seeing in the data. It's very inconsistent with what Wall Street seems to think, what a lot of people I know seem to think about the economy, and certainly what the Fed is saying about the economy. If they're right about the economy, they're going to have to start worrying about this sooner than later, right? And that's interest rates and that's inflation. I'm going to jump around a little bit here. I was going to show you this last, but let me show it to you now. These are CPI swap rates. So these are kind of a way to look at inflation expectations, and just look what they've done here just very recently. They've shot up substantially. I'm not saying that 2.4% is a high inflation rate. I think it's actually going to be higher than that on average over the next number of years. But when we look at the 10-year swap rate, it's moving in that direction. So cutting interest rates in this environment could ultimately become somewhat inflationary. Now, that may be okay with the stock market for the moment. We shall see. We do know that bottom 40% of income earners are suffering mightily because of inflation. And suddenly something that had the Fed primarily concerned big time not that long ago, and the data really hasn't changed a whole lot other than inflation has come off the boil a bit, which we talked about would happen as the economic indicators suggested it should. But suddenly it's not as big a concern, even though 0.5% can just engender all kinds of animal spirits, as people, rush back into these markets. I think there has been massive, even though the market's held up okay, there's been quite a bit of outflow leading into the last couple of days. You noticed yesterday, markets were actually net down on the day, even though we had this great 50 basis point cut overnight, and then a lot of commentary from big Wall Street firms and so forth got this train rolling here today. Also, the volatility index, for example, was trending higher. I said that a couple of days ago on the blog. The VIX is actually seems to be rising. Now, what that says to me is people were probably hedging a potential disappointment, right? So hedging means, in the context of my conversation here, it's buying, for example, protection against a fall in the S&P, put options and so on. As we've discussed multiple times the last couple of years, when that happens, when people start betting with options that the market's going to fall, the dealers, the sellers of those options have to hedge their downside risk because they will short or sell the underlying security, and that can exacerbate some of the downside. What it unequivocally does is that when we get a move in the opposite direction and people abandon those puts and or start buying calls, those dealers have to cover all those hedges, buy back the underlying. And if now they're short calls or they sold calls to investors, now they got to buy the underlying to protect themselves against the upside risk that they have because they're on the other side of that trade. I know this gets into the weeds, folks, but make no mistake, that's leverage underneath this market that is having a massive impact on the day-to-day moves. And that's not necessarily a good thing. It feels good when we get this massive move higher. But if it's happening, partly because of things like short covering, you know that it's not fundamentally based. And we know from valuations in our view of macro that there's a massive question whether or not this is fundamentally based and at all sustainable. Now, I do think that this very well could be sustainable. I mean, the fourth quarter is coming, and that tends to be the best time of year. We may get more volatility between now and then. It wouldn't surprise me. And in fact, nothing would surprise me at this point. But, given, all things in the aggregate, again, our general conditions index showing better signals, although still negative, the Fed aggressively cutting interest rates, I can see, people abandoning their concerns and rushing into stocks despite these record valuations. So I absolutely think we need to be on our toes. Clients, if you're watching your stuff, I know you're not complaining. I'm certainly not complaining about the moves, but we are not willing to abandon all caution and chase these things. I've shown you over and over again from too many angles. This is not the look of a market that's about to enter, a sustainable multi-year upswing. Doesn't mean conditions can't create that scenario, but they are not creating that scenario right now. This looks more like speculation, late cycle, FOMO, fear of missing out among retail investors doing what they tend to do, and then professionals who just can't afford to underperform, even though they may know that fundamentally the gig is up. They can't let this thing run for another 3 months and let it leave them behind. Those would be your hedge funds and people who live and die by some, benchmark measure. For the sake of our clients, we unequivocally refuse to live and die by any benchmark measure. Our purpose professionally is to manage prudently, risk manage, if you will, our clients' wealth, grow it over time, but always position within the context of what the overall risk-reward setup demands, not what the stock market is doing when we're probably late stage and things look pretty bubbly. And let me reiterate, though, that this can continue for quite some time going forward. Now, with that in mind, let's just take a look at first the dollar, and then we'll look at the technicals. And I said the other day, the path of least resistance for the dollar is lower, and you can see what the dollar has done the last few days. If the Fed is going to be aggressive relative to other central banks, that from an interest rate differential standpoint, that's net weak for the dollar. If we do end up in recession, the world tends to run to treasuries. That tends to be net positive for the dollar. A weaker dollar tends to be net positive for things like stocks and commodities. It really goes against the grain of what these policymakers say they're trying to do, and that's help the everyday person. A weaker dollar in no way, shape, or form helps U.S. citizens who spend those dollars. It actually weakens their purchasing power. In a sense, it's inflationary, right? So we'll keep our eye on the dollar. As for the S&P, remember I've said recently that even if we move our way into all-time highs, which would not surprise me, it's not going to nearly get rid of these bearish divergences in momentum. There's the moving average convergence divergence, and there's the RSI. And I've shown you over and over and over again historically, and let me just run a 5-year chart, how important those can be just in terms to be thinking about, what the next major move is in the market. Here we were right before that 30% dip in 2022, all-time highs, rolling over, bearish divergences. Look at this, all-time high, similar action even moving into it. Very big bearish divergences, right? This is not a sell signal, by the way. Sell signal would be a break of this uptrend, right? But this is a look that just on the daily chart that just is not all that inspiring if you're anything other than, say, a short-term trader or a swing trader, right? Here we were even before COVID, upward rising wedge, and that's what we have here. I haven't drawn the lines yet. Bearish divergences, right? And I showed you that. And then same thing on the other end, right? Illustrating, and I said we had a hugely bullish divergence right there. And that's where the market bottomed, right? And then we had, periods where we had corrections. We had overbought conditions and so forth. So this is pretty good stuff, but it doesn't always work from a short-term standpoint, right? I mean, these bearish divergences were there here, and look, the market is still moving higher. Perhaps more importantly, as you look at the weekly chart, this, to me, remains a very bearish chart. You have your rising wedge pattern. We may very well break back in there, but divergences coming off of overbought and still an active sell signal on the weekly MACD, right? And again, I like the longer-term charts. They tell us more in terms of longer-term trends, and they're slower moving. They're not nearly as noisy. So again, we had this same pattern, right? Going into that 30% decline in 2022. And remember, see, it rolled over and it fought with it. Here we are at all-time highs before it rolled over. Man, this look looks very much like this look right here, right? And it does down here as well, even more overbought going into it. And it does not mean this is going to happen. In fact, I just said that market could easily, probably should lean bullish, maybe after we get through mid-October, right? But, the charts don't really give us that green light. Maybe they will by then, but they don't right now. Lastly, the NASDAQ 100 index. This is where tech is really concentrated. Again, massive move today, as I pointed out, off of the highs of the day. And interestingly, lost it right here at 485 resistance. You can see that this is important. We lost it there, beat it, and boom, keep testing that, tested it again. And right now, technically speaking, have failed the test. Doesn't mean we're not going to go screaming higher next week, but we may have to fill this gap first before that happens right here. And keep in mind, folks, we're still a chunk off the all-time high in the NASDAQ, and that's the case in tech stocks as well. So today, could have been people thinking that tech was oversold. We shall see. And then when we look at momentum, even from here to here, hitting back to this resistance, even that little move right there created a bearish divergence here on the MACD. And slightly on the RSI as well. That can be burned off, the first part of next week. We rush up to these highs, though, and we're still going to have some very scary bearish divergences on the Qs, which is the ETF that tracks the NASDAQ 100. Same thing, folks, looking at the 5-year look, and we can look at a 50-year look. And these are the kind of technical setups that just say, be on your toes here. You want to trade this short term, breaking through this trend line right there. Let me go back. You could argue that's a bullish breakout right there, and it is, by the way. It definitely is. Question is, where should your target be? Should it be right there? Did it get all it's going to get? Or should it be up here at new all-time highs? I think that's highly in the realm of possibility, if not over the next 2 to 4 weeks, certainly by the end of the year. But again, the technicals, and I'll leave it here, are telling you to maybe not completely back up the truck to this. We're not doing that here. We have plenty of equity exposure to do well in that environment, but we're not worried about catching all of it at this juncture. Our macro work, the technical work, our valuation work just says that if something does break, the downside is exceptional. So we just have to be on our toes and stay hedged to mitigate that if and when that does occur. So folks, I will leave it there. Hope you have a great rest of your week and a great weekend, and I'll be back at you next week. Take care. Thanks again. Bye-bye.